Good afternoon. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on our heritage.org website on all of these occasions. I would ask everyone here in-house if you'll be so kind to check cell phones and see that they're turned off as we prepare to begin. We will, of course, post the program on the Heritage homepage for everyone's future reference. And our internet viewers are always welcome to send questions or comments simply emailing us at speaker@heritage.org. Hosting our discussion today is Ray Hederman, Jr. Ray is director of our Center for Data Analysis and the Lazoff Family Fellow. He is Heritage's chief number cruncher. He oversees Heritage's original statistical research on taxes, health care, entitlements, energy, education, and employment, among other issues. He is a founding member of the Center for Data Analysis, having served CDA as a research fellow, assistant director, and most recently as deputy director. Created in 1997, our Center for Data Analysis provides the public policy community with state-of-the-art modeling, database products, and research assistance. Please join me in welcoming Ray Hederman. Ray?
Thank you, John, and thank you, everyone, for joining us here, especially for such a happy topic like austerity. It's glad to see so many people interested in a word that has 9 letters and not 4, despite what you might have been reading from the New York Times and other proponents of big government spending. I think the mere mention of the word austerity or balanced budget conjures up images of hard-hearted people pinching pennies afraid somebody might be having fun somewhere. But the basic reality is that many countries in the world have engaged in a variety of fiscal policies as a result of the economic crisis of the last several years. Some countries increased spending, started to lower taxes, but then engaged in tax hikes like the United States. Other countries did the opposite. Today, we're here to discuss those decisions and what impacts they had on the economy and the workers in those countries. This is also the official release of a new data product that brings together a compendium of data on 37 different countries, many in Europe and the United States. We feel that this is a valuable tool as the data sources can be downloaded, and we encourage the use of other researchers. Here at the Center for Data Analysis at the Heritage Foundation, we strongly believe in the transparency of our data, and we ask other researchers to use our data that accompanies our report. Finally, I think, and most importantly, there's a great deal of confusion about the European response to austerity. Europe is not a single country, but instead is a collection of individual sovereign nations that reacted in many different ways. The overall results for each country are highly dependent on choices that politicians made to solve their own unique economic and physical problems. We're delighted to be joined by some researchers across the Atlantic to discuss the topic in their respective countries. We believe that this new piece of research can provide clues on how policymakers should deal with the problems of their debt going forward. Because every country in this study, sooner in the case of Greece, later perhaps in the case of Germany, are going to have to deal with the problems of debt accumulated by previous governments. Unfortunately, here, the United States is no exception in having to deal with its debt. And I cannot be more delighted to introduce our keynote speaker, who understands America's fiscal issues and wants to solve those problems with the right solutions. Congressman Tom Price, a doctor, is the vice chairman of the House Committee on the Budget. Congressman Price is a man of ideas in Congress, pushing major reforms on topics such as health care and other fiscal issues. He is former chairman of the House premier conservative organization, the Republican Study Committee, and former chair of the House Republican Policy Committee. Congressman Price serves on the House Committee on Ways and Means, as well as the House Committee on Education and Workforce, and currently serving his 5th term representing Georgia's 6th Congressional District. Prior to coming to Washington, Congressman Price served in the Georgia State Senate, where he was the first Republican majority leader in the state's history. Before embarking on public service, Dr. Price spent more than 20 years practicing orthopedic surgeon. He also served as an assistant professor at Emory University School for Medicine and medical director of the orthopedic clinic at Grady Memorial Hospital in Atlanta, teaching resident doctors in training. Please join me in welcoming Congressman Price.
Thanks, Ray, so much for that generous introduction. I appreciate that, and thanks to Heritage for asking me and inviting me to speak with you all today. I'm honored to be joined by these distinguished panel members. As Ray mentioned, this is about austerity, and curiously, during the rollout of his budget proposal earlier this year, President Obama defiantly claimed that the age of austerity is over. Austerity. It's a frightening thought that the President considers federal government spending of nearly $3.5 trillion last year to be austere. It's important to note that in 2004, just a few short years ago, federal total spending was $2.4 trillion. The truth is that America is not and has not been in an age of austerity. Despite growing concerns about our weakened economy and our fiscal insolvency, Washington continues to spend like today's bills don't matter and tomorrow's will never come. In 2008 and 2009, America experienced one of the most significant upheavals, economic upheavals, in our history. And across the Atlantic Ocean, our friends in Europe were dealing with fiscal crises and issues of their own. Congress's own research arm has identified 4 major economic problems that led to the troubles in the Eurozone. High debt levels and public deficits, weaknesses in the European banking system, economic recession and high unemployment, and persistent trade imbalances within the Eurozone. With stagnant economies hampered in part by redistributive policies that destroy jobs and disincentivize growth, these nations were also experiencing an ever-growing entitlement crisis. The result? Widespread economic turmoil that turned into political and sometimes civil unrest. Leaders throughout Europe debated how to repair the economies of countries like Greece and Italy and Spain and Ireland and Portugal without taking down the remainder of the Eurozone. Each country chose a different approach, as Ray mentioned, based upon its own history, its social structure, and its economy. So what caused some countries, like Portugal and Ireland and Greece and Spain, to endure more painful measures and still face economic and fiscal disarray, while other nations, like the United Kingdom and Germany, imposed minor measures and are currently enjoying elevated levels of growth? In his study of the recent European fiscal crises, Dr. Firth concludes that spending cuts were less harmful than tax increases when reducing deficits. He also notes that countries that practiced fiscal discipline before the recession had greater flexibility and firmer recoveries. America needs to be paying attention. As our nation approaches a similar fiscal crisis, perhaps we should take some lessons from our friends in Europe. First, however, we need an accurate assessment of the magnitude of our problem. Today, our national debt here in America has exceeded $17.5 trillion, a level above our entire gross domestic product. But a more complete view of our country's fiscal situation offers an even bleaker outlook. Over 1,000 economists, including 15 Nobel laureates, estimate that our long-term fiscal gap, our unfunded liabilities, or those obligations that current law has already prescribed, measure $222 trillion. That's right, $222 trillion. Just as in Europe, America's impending fiscal crisis can be attributed to some very specific problems: anemic economic growth and compounding entitlement costs. While our financial situation is not at present as dire as those facing Europe, a failure to act now will result in a crisis similar to theirs, only with far more catastrophic results. As the world's largest economy, there are real consequences, international consequences, to an economic and fiscal collapse in our country. And in our own backyard, such a disaster would most adversely affect the poor among us, those least able economically to withstand more headwinds. We have a moral obligation to prevent this from happening. In order to determine how best to solve the challenges that lay ahead and prevent the need for actual austerity, we must first understand how we got to where we are today. Our current economic stagnation has only exacerbated our already existing fiscal problems. At the end of May, as you may recall, the Commerce Department announced that our nation's gross domestic product contracted by 1% annualized last quarter. Couple that with news that we already know about our economy, a labor participation rate right now that is as low as it's been in nearly 4 decades, and stagnant wages, and it's all the proof we need to know that what we're doing right now simply is not working. Current policies are clearly harming our economy, preventing a more robust recovery. Most obvious of these is our unfair and confusing and cumbersome tax code. It discourages growth and investment and job creation. It punishes the people who actually make our economy work. And in doing so, it blocks the stream of revenue that funds the very government programs that are already going bankrupt. If we are serious about economic growth, we need to also be serious about real tax reform. Republicans believe our tax system ought to be flatter and fairer and a lot less complicated. We need to lower the rates and broaden the base and end cronyism of special loopholes. And unlike our Democratic friends, we certainly don't want to take more from hardworking American families simply so Washington can spend more. That's because we believe economic growth happens when the American people keep more of their hard-earned money to save and spend and invest as they see fit. And history has shown that reducing taxes actually increases revenue to the federal government. The tax reductions and programs of both President Kennedy and President Reagan generated more revenue for the federal government. In addition to fixing the revenue side of the equation with tax reform, we must also address the spending side, especially those automatic and entitlement programs whose compounding costs greatly contribute to our national debt and our continued deficits. The proposed budget by House Republicans over the last 2 years, 2013 and 2014, what we called the Path to Prosperity, does just that. When it comes to our nation's safety net programs, particularly Medicare and Medicaid and Social Security, there is no shortage of literature and actuarial reports and government studies that make it absolutely clear that these programs are in deep financial trouble. Some, like the Social Security Disability Insurance Program, which goes broke in 2016, are a more immediate concern than others. But they're all predicated on a set of fiscal assumptions that, frankly, no longer ensure long-term viability. Current workers paying for current retirees, promised benefits that far exceed a funding stream. These are the hallmarks of a failing system in a society with changing demographics, where 10,000 Americans reach retirement age every single day, and that will continue for at least the next decade. It's also fairly obvious that if we, as a society, surrender to demagoguery and fail to accept the facts before us, the damage to our nation's financial well-being will be significant. But more importantly, if we don't act on a reform plan, there will be tremendous pain and suffering endured by those who depend upon these programs for their own security and their own well-being. Now, no one is interested in watching Medicare and Social Security collapse into turmoil, removing health and financial security for seniors. If we come together and understand that, then we must ask the next logical question, which is, how do we make these programs work now and for the future? In fact, how do we make these programs work better so we're able to provide folks with more choices and more security? The solutions that we've supported on Medicare reform and Medicaid reform are about giving retirees and those in need of assistance more choices while making realistic the benefits that we have, as a society, have promised. When it comes to Medicare, we believe that those who are in or near retirement should be able to keep the current plan if they choose. In the future, the program should offer financial assistance through what we call premium support or a benefit check to purchase the health coverage that they want for themselves, all the while making certain that traditional Medicare remains an option. When it comes to Medicaid, we say give the states the flexibility, real control over the resources provided so that they can deliver the right style of services to their diverse communities. What we propose would ensure that these programs have not just a future, but a brighter one. Reform is the avenue to improvement of services as much as it is a way to stave off fiscal collapse. Now, in addition to these vital policy reforms, we also need to fundamentally change how Congress spends money. As Vice Chairman of the House Committee on the Budget, I'm acutely aware of the problems that are caused by our outdated budget process, specifically the Congressional Budget and Impoundment Act of 1974. All of the inertia in Washington is to spend more money, regardless of whether or not Congress acts. And the inverse ought to be true. As just one correction, if Congress doesn't do its job, If it doesn't complete its appropriations bills, then spending should automatically decrease, not increase, as is the current case. In our fiscal crisis, the trajectory of federal spending should bend downward, not upward. We also need to know the real consequences, fiscally and otherwise, of the laws that we pass. Right now, that's virtually impossible under current law. The rules under which the CBO works, static scoring or what I call non-realistic scoring, skew their findings and their recommendations. This oftentimes results in huge inaccuracies in projections compared to real world. Obamacare is a classic example. Projections from the Congressional Budget Office grossly underestimated the cost of the president's signature piece of legislation, literally by over $1 trillion, as time has shown. This doesn't even account for the law's apparent harmful impact economically, seen in lost wages and widespread joblessness and stagnant economic growth. Just as you wouldn't buy a car, none of you would buy a car if you didn't know the costs of the automobile totally, Congress shouldn't pass a law without knowing what it really costs. Now, there are a number of positive reforms that should be considered and debated and voted upon in Congress. That's why one of the reasons I've introduced the Pro-Growth Budgeting Act. This bill would require the Congressional Budget Office to perform a realistic, dynamic scoring analysis. A dynamic scoring analysis would better predict and depict how passing legislation in Washington affects the nation's economy, whether it's growth or contraction in the economy, jobs being created or jobs being lost, or revenue going up or down. It would also serve as a reminder of the true cost of government to the American taxpayers who are stuck paying the bill. If members of Congress had a more realistic and perhaps more sobering understanding of the true cost of government, perhaps they would think twice about expanding it to the detriment of the people. Further, the federal government should not spend more than it takes in, a pretty simple concept. American families can't spend more than they take in, American businesses can't spend more than they take in, and neither should Washington. It's absolutely imperative that we pass and adhere to a balanced budget. The budget passed by House Republicans these past 2 years, our path to prosperity, not only comes into balance within 10 years, but it also puts us on a path to pay off our national debt. By comparison, the budgets offered by the White House and the President and the Senate Democrats, when they, in fact, produced a budget, never, ever, ever come into balance. It's disconcerting, truly, that they don't seem to treat our nation's fiscal emergency with the seriousness that it requires. The House Republican budget is proof that it is indeed possible to honor America's most important priorities, providing for a strong national defense, repairing the social safety net, securing and saving and strengthening Medicare and Medicaid, and growing our economy, all without raising taxes or spending money that we don't have. Responsible, accountable governance that respects future generations. Now, all these are necessary goals that we must achieve in order to get our nation back on the right path. But we can't do it overnight. We must begin by making small and important gains, gains in the direction of limited government. As conservatives, it's important that we appreciate that practicing smart politics doesn't mean abandoning principles, sound principles like limited government and individual liberty and fiscal restraint. It just means getting better at implementing those principles than the other side is at destroying them. Now, some have suggested that incremental changes fail to recognize the apparent severity of the challenges that we face. On the contrary, conservative incrementalism seeks to address the current crises and to prevent future ones in a principled, logical, and strategic way. It is a sure way to secure real gains. Now, we do this not only by opposing the liberal policies that have failed and gotten us in the position that we are right now, but also by articulating how we would do a better job getting us on the right path. That American principles are conservative principles, and that our policies, conservative policies, embrace the vision that in a fair and accountable way, we support the greatest amount of opportunity and the greatest amount of success for the greatest number of people so that the greatest number of American dreams can be realized. Now, with a formidable political opponent and oftentimes an adversarial media, this is a tough battle. And make no mistake, in the public battle of ideas, our liberal friends will come armed with any scholarly work that claims that to justify their confiscatory tax schemes and redistribution mantras. Just take a look at the left's current love affair with Thomas Piketty's capital in the 21st century. But I'm up for the fight, and I know that my colleagues in the House Republican Conference are as well. And I know that groups like the Heritage Foundation and Cato Institute and AEI and others are ready to stock our intellectual arsenals with the information to truly make a compelling case to the American people. From Sacramento to Cedar Rapids, from Philadelphia to Fargo, and from Detroit to Decatur, Georgia. With all of this talk about economic and fiscal crises facing the nation and the cautionary tale of struggles by our European friends, there seems to be little reason to be hopeful, not optimistic, but I am. And my optimism is affirmed when I look to the states. According to the United States Department of Labor, the states with the highest drop in unemployment last year, South Carolina, North Carolina, Indiana, Nevada, Tennessee, Louisiana, Pennsylvania, Ohio, New Jersey, all are led by Republican governors. Most of the states with the fastest growing economies are led by Republican administrations and legislatures. These governors and legislators are creatively addressing the challenges that we face, from education to health care, and their constituents approve overwhelmingly. Yes, there are many reasons to be optimistic, but we also must be proactive. With all due respect to our international friends in the room, I am unapologetic in my insistence that the United States is truly the most exceptional nation in human history. In our relative infancy, the American way of life has fostered real and lasting prosperity for hundreds of millions of people within our borders and has served as an inspiration for billions worldwide. En route to America, at the time of our revolution, Marquis de Lafayette wrote to his wife. He said this: "The happiness of America is intimately connected with the happiness of all mankind. She is destined to be the safe and venerable asylum of virtue, of honesty, of tolerance, and of peaceful liberty." Indeed, we as Americans are the beneficiaries of humanity's greatest experiment, as well as a living example to the rest of the world that freedom and prosperity are actually most attainable when government is limited and responsible and accountable and deferential to the people. That's why we have a real moral obligation to act now to secure the future of America. Conservatives must stand ready to fortify our ideas, demonstrate political courage, and do the hard work necessary to rally and persuade our fellow Americans that ours is the best way to correct the course of this country and to foster the prosperity that they seek. Let me thank once again the Heritage Foundation and the scholars who are here today. I look forward to continuing this discussion as we work together to save the American dream for generations to come. Thank you so much.
Thank you, Congressman Price, for that great synopsis of the challenges that face us. And as our next panelists start making their way to the stage, let me use you as an advertisement for 2 weeks. We're going to have House Ways and Means Chairman Dave Camp here talking about two of the items that Congressman Price brought up: the importance of dynamic analysis and scoring by the Congressional Budget Office and the Joint Tax Committee, as well as the importance of tax reform and what that means to the economic future of the United States. So I'm delighted to introduce three of the actual authors of the report. I'm going to introduce them in order of that they will be speaking. First, and we're very excited, is to have her here all the way from Stockholm, Sweden, traveling across the Atlantic, is Malin Sahlin. She is responsible for economic policy at the Timbro, a free market think tank located in Stockholm. She's an economist and has previously worked at the Confederation of Swedish Enterprise, where she played an active role in debates about reforming the Swedish labor market. In 2012, Malin published a book about youth unemployment in Sweden. The title, which I won't even try to pronounce, translates loosely into English as Youth Unemployment, When Should the Wall Be Torn Down? We're delighted to have you here. From the Cato Institute Center for Global Liberty and Prosperity, our second speaker is Dalibor Rohak. Special congratulations to Dalibor. He recently finished his PhD in political economy from King's College in London. His work focuses on international political economy and development, and he has worked at the Legatum Institute, the Office of the President of the Czech Republic, the Center for New Europe in Brussels, and what is the Wiedenfeld Scholar at Oxford University. Finally, my own colleague, Dr. Salim Firth, researches and explains how public policy affects economic growth. As a senior policy analyst in macroeconomics at the Heritage Foundation Center for Data Analysis, he covers fiscal policy growth issues with an emphasis in the role of entrepreneurship and incentives in the U.S. economy. Dr. Firth writes regularly for the Wall Street Journal's blog, Washington Wire. Prior to joining Heritage in 2012, he was a visiting assistant professor of economics at Amherst and received his PhD in economics at the University of Rochester and is editor of the paper that we're presenting today. So with that, let me turn it over to Malin for our opening speaker.
Okay, so hi everyone, and thank you, Ray, for that nice introduction. I'm very honored to be here. It's very interesting for me too to come here to Washington and meet a lot of interesting people. Thank you. So, thinking about Sweden and the financial crisis, you might be thinking about that guy. That is Mr. Anders Borg, which is our finance minister. He's known for his ponytail and his earring, but he's also known for managing Sweden through the crisis in a very successful way. Actually, he was more popular during the crisis than before and after, which might be quite unusual for a finance minister. And he was also named the best finance minister in Europe by the Financial Times in 2011. But to learn how he was so successful, we need to look back in time, around 20 years. We had a much more severe crisis than in Sweden. The crisis in the early 90s, which we call a bank crisis, that crisis was preceded by 20 years of mismanaged economy. We had somewhat of a socialistic experiment going on in Sweden then. We actually increased the taxes, that is total taxation of the in the economy, from 20% in the 50s up until above 50% in the 90s. And the payroll taxes increased from 11% in 1970 to 39% in 1979. Yeah, that's a lot. And together with that, we had a responsible wage formation system where we had the idea that everyone should earn the same, not caring about their actual work. So wages actually some years increased with over 10%, that is nominal wages. Obviously, we got the problem with inflation, so some years we had double-digit inflations too. So ordinary people didn't get any increase of disposable income for 20 years, from 1970 to when we came out of the crisis in the 90s. The inflation together with this quite sudden deregulation of the financial markets gave us a house bubble, and when people realized that the government wasn't handling this very well, they stopped consuming and the house bubble burst. So there we had the crisis. And the immediate effect of that was that growth was down by 2%. And when growth fell by 2%, employment fell by 5% in the worst years, so that's kind of severe. Employment actually fell for 3 years in a row, and unemployment was up by over 10% for 5 years running. But maybe the most severe thing in the long run was that the public debt rose until almost 80% of GDP. Actually, politicians from both party lines realized the severeness and learned the lesson. So we put an expenditure on the public sector, or expenditure ceiling on the public sector. We tightened the budget process so that every budget area needed to make ends meet and take responsibility for their own spending. We made the central bank independent from the government and gave them the only mission to keep inflation under control. We also reformed tax and pension system, which were crucial for our public finances. Even though I think we now have to reform the tax system again. We became members of the EU, and I guess you can say a lot about the EU, but it actually gave our enterprises a big new market to act on, and also a lot of new competitors, so that they had to shape up, which is obviously good for us in the long term. And in the sense of pro-market reforms, we deregulated media, telecommunications, public transports, and we imposed free choice of schools and stuff like that, that has, for me, seems to be great democratic reforms. This have definitely helped the Swedish economy. The header there is probably not very good, but it's sort of steady. The 20 years after that crisis, between the mid-90s and until the Great Recession, we had a growth rate between 1.5% and 4%. So that's quite steady until the crisis came in 2009. And as you can see, also the public debt started to decline, and it actually has been declining since then, almost every year. But so came the crisis, as you all know, and even though the growth fell by 5% in 2009 due to Sweden being a small and open country and very dependent on our exports, the employment fell only by 2%. So you can see the difference from the last crisis, where economy fell by 2%, but the employment fell by 6%. So that's our labor market works much better now. And this picture again, you can see how the debt only increased for one single year, and that with only 1 percentage point. So the actual measures that we put in, that we needed to put in, we put higher capital demands on our banks because we have a huge banking sector. So our demands are higher than they are in the rest of the EU. We created a stability fund to, in the future, if needed, help banks and credit institutes. We created a support bill with the right to intervene in banks and a voluntary guarantee program for banks, which only one bank actually joined, and it ended in 2011. But I think the most important one was the crisis agreement between unions and employers within the industrial sector, where they agreed to work less for less pay for 6 months, and then they got back to normal again, in order to not be losing their jobs. That wasn't very popular amongst other unions, but it worked well. So I think that the crucial lesson that you could learn from the Swedish experiment or the Swedish experience is the no-brainer that you got to keep public spending under control. And actually, you can win elections on that. We have like 2 recent examples on that in Sweden. That you should use in the long-term growth reforms to build a strong economy with prosperous and small enterprises that can grow and hire more people, and that will help the economy. And finally, you should use these two ways of thinking to never end up in a crisis, because it's much easier to avoid a crisis than to come out of one, obviously. So as Dr. Price said, if you have done your homework before, you can be more flexible when a crisis comes. Thank you for listening.
Congressman Price, ladies and gentlemen, good afternoon, and thank you obviously for inviting me to this forum. I'm thrilled to be here. It's fabulous to see so many of you interested in fiscal trajectories of obscure European countries like Hungary. And I would like indeed to talk briefly about Hungary and to showcase it as an illustration of how fiscal consolidation should not be done. So as a sort of polar opposite case to the example of Sweden. And I think there's a hint of sweet irony in the fact that Sweden is being raised by American conservatives as an example of how to pursue pro-market reforms and fiscal responsibility. But I would like to emphasize that actually there is a lot to be learned from Swedish pro-market reforms. And in many ways, free marketeers, conservatives should study Sweden with great care. However, I'm going to talk about Hungary, because I think Hungary is an example of how things can go wrong simultaneously on many different fronts, and how a series of really poor decisions by consecutive governments has bad effects, not just for the economy, but for other areas as well. And to be more specific about these extra economic effects or political effects of Hungary's economic policy, let me just say a few words about the current political situation. As some of you might know, Hungary, after the April election, is governed by one party, Fidesz, led by the Prime Minister Viktor Orbán. And although that party is nominally right-wing or right of center, and Orbán indeed has a reputation as a pro-market reformer from the late 1990s. The only operating principle of that party at this current time is populist nationalism, which I think is already proving to be very damaging for the country and is going to be even more damaging over the longer term. Worse yet, the leading opposition party in Hungary is not, as you would expect, some large social democratic political group, but is this organization called Jobbik, which is an openly xenophobic, racist organization with neo-Nazi roots. But don't take me wrong. Hungary is still, a democratic, fairly prosperous European country, but it is on a very dangerous path, and I would be inclined to argue that bad economic policy decisions of the past 7, 8 years have a lot to do with its current state and its rather bleak prospects. And so to think about Hungary's economic problems, I think I would start by articulating 3 observations, claims about fiscal consolidations, which I think won't be too controversial with this audience. The first one is the observation that the type of austerity matters. Consolidations that rely on permanent spending cuts tend to produce much better results than consolidations that rely on increases, sometimes temporary, in government revenue. And that's confirmed by academic literature, the famous paper by Alesina and Javazzi. It's also confirmed by this compendium that is just coming out from the Heritage Foundation. The second point, which might sound trivial on surface, is that the rule of law and predictability of the legal regime matters. Of course, in the process of fiscal consolidation, policies need to change, but it needs to be done in a way that anchors expectations. It doesn't create uncertainty about what's going to happen next. And finally, we also know from the experience of many countries that structural reforms do help, and Sweden is a perfect example where fiscal consolidation was accompanied by very deep structural reforms, privatization, liberalization of the labor markets, and so on and so forth. And that did sweeten the pill a lot. And so in my remaining time, I would just like to describe very briefly how Hungary's government acted against the spirit of all 3 of these principles, if I may say so, with predictably bad results. So between 2008 and 2001 and 2008, Hungary got itself into a pickle, partly by increasing government debt by almost 30 percentage points relative to GDP. So the fiscal outlook was really bad at the beginning of the crisis. Simultaneously, the country accumulated huge foreign-denominated private debt. Households took mortgages denominated in Swiss francs, and when in 2008 the Hungarian forint depreciated, that burden of debt just exploded, and there was a huge increase in non-performing loans in Hungary. So in 2007, the proportion of non-performing loans of all loans was roughly 2%, and that number increased 7 times to 14% in 2011. And so that had an effect on the creditworthiness of Hungarian households. It created a huge deleveraging burden that they needed to cope with, but it also had an effect on the creditworthiness of the government. So very quickly, Hungary was one of the first countries that asked for an aid package from the EU, IMF, and the World Bank, and got it very quickly. But still, the economy went through a deep recession in 2009, and the growth has been really sluggish since then. It never really recovered the pre-crisis growth levels. Unemployment went to double digits, remained more or less in double digits. It's going down slowly this year and last year. But okay, so what did the government do in response to these events? On the fiscal side, there was an attempt to bring deficit under control, and they did cut some spending. I think public spending went down by roughly $1 billion US. But at the same time, expenditure has grown by more than $5 billion. So it was really a consolidation that relied primarily on spending, on revenue increases. And it should be said that Hungary already started this process with a fairly big public sector compared to other Central and Eastern European countries, and so in 2012, I think public spending accounted for roughly 50% of GDP in Hungary and only 37% in neighboring Slovakia. Also, the particular form of revenue increases played a role. So Hungary didn't just increase any taxes. I mean, they increased the VAT, and they tried to cut the income tax, but they then introduced these targeted levies imposed on particular industries, on the financial services, on retail businesses, on telecommunications, trying to sort of extract rents from those filthy rich foreign investors. And that obviously is not a good idea. That befuddled the investors, created uncertainty about the future. In 2011, Hungarian government seized 14 billion US dollars worth of private pension fund assets and replaced those with essentially unfunded liabilities to be paid by the government at some uncertain point in the future, which, I mean, that did plug the hole temporarily, but it's not a reasonable way to proceed with fiscal consolidation. And that actually brings me to my second point, the idea that rule of law and predictability of the legal regime matters. In Hungary, there was really a hugely ad hoc and unsystematic response to the crisis. These targeted levies and nationalization of pension funds. There were also politically motivated attacks on the independence of the central bank, the authority of the fiscal council, which was created initially by Orban, but once it started to criticize government's budgets, it was essentially the people on the council were replaced by political nominees. And there is also a story to be told about the treatment of foreign creditors, where the government sort of decided unilaterally that there would be a haircut imposed on those creditors without really thinking twice about the effects that that can have on the creditworthiness of Hungarian households. But economic policy aside, there's a deep problem in the Hungarian economy which has to do with structural rigidities. So, and we know from Sweden and other places that fiscal reforms should be accompanied by structural reforms, by liberalization, by opening up of the labor market. And Hungarians have done nothing of that sort. Although there is a lot of low-hanging fruit in that country that could be harvested very easily. So if you look at World Economic Forum's Global Competitiveness Report, the burden of regulation in Hungary is among the heaviest in the world. So the country ranks 138th out of 144 countries on the report in terms of the burden of regulation, which is quite stunning, and very little has been done about that since the beginning of the crisis. Also, Hungary has one of the lowest labor participation rates in Europe. So looking at the unemployment figures may be quite a bit misleading, because there are lots of people who have just given up on the labor force and on working altogether. So there has very little done on that front, and it's in many ways puzzling. But more importantly, I mean, it really puts the country on a very dangerous path economically and politically. And I'm not a Hungarian, but I love the country very much. It's a lovely place to visit, and I just hope that it's not too late to change the course. For that, I stop here, and thank you.
Thank you, Dalibor and Malin. That was depressing. So we've heard about a country that did some things right and prepared themselves well for the crisis. We've heard about a country that sort of did everything they could possibly do wrong. And I'm going to sort of talk about a country that did nothing and see what happened. So Olivier Blanchard, who's now the chief economist for the IMF, wrote that Portugal faced a period of sustained high unemployment leading to lower wage growth until they could get their unit labor costs down. And this was going to be a long and painful process. He wrote that in 2006, when the world economy was booming. So in 2006, a good economist who spent a lot of time in the data looked at Portugal and said, these folks are going to have high unemployment for a long time. They're going to have low wage growth, probably negative in real terms. And it's going to be long and painful politically and in terms of people's private lives and how much their earning power is going to decrease. That was before a major global financial crisis that really smashed into all of Portugal's major trading partners. And why was Portugal in this situation? And when we look at, say, this miserable growth record that Portugal and some of the other Southern European countries have had since 2008, is it because of the crisis, or is it because they had set themselves up for this? They were going to have a miserable decade anyway. The crisis made it worse, and the fact that they didn't do any of the structural reforms, fiscal consolidation, competitiveness reforms, while the economy was booming worldwide, while there were strong export markets that they could take advantage of, they set themselves up where a relatively mild crisis, even though this was not a relatively mild crisis, was going to put them into a tailspin. And when you get a relatively strong crisis, then that's disastrous, and we have major upheaval in Greece, Portugal, Spain. So why did Portugal end up in this situation? Briefly, and this you can get into a lot of details here, and there's some great work by Ricardo Reis as well as Blanchard. They had a weak financial sector. They didn't have fancy credit default swaps. They didn't have a housing bubble. They didn't have banks making tons of loans. In fact, they had a relatively small lending sector. Their banks were very unsophisticated, tended to not take large risks, and just kind of spread their funding around with the existing businesses and sort of protected the incumbents. Like, if we know you, if you've been here for a long time, you can get a loan. Somebody new who's got a crazy idea probably isn't going to get a loan. That led to a lot of very inefficient businesses staying in business for a long time. Labor costs went up. They did not take advantage, even as say Spain did. Spain at the same time is having a very strong period of growth. Portugal's not sharing Spain's growth because they're not able to take the money that's coming in from the EU and get it out to people who are going to do things at least efficiently with it. Spain had other problems like a housing bubble, and so those capital flows masked some of the weakness in the 2000s. But even if you took a long look at it like Blanchard did, you could see even in 2006, this is a country that hasn't grown hardly at all in 10 years and is facing major problems, and their costs are really high. Why would you move your factory to Portugal? Why would you buy a Portuguese product? It's more expensive than the same product from Italy or Spain or Greece or Germany or Sweden. So what happened after that mattered. There were policy decisions that were taken. In some cases, the Portuguese parliament has tried to make cuts to say, public sector wages, and their constitutional court has thrown out those cuts multiple times. So they're having an internal political battle about whether they're even allowed constitutionally to reform the government. Great question. Those things matter, but in a sense, they matter at the margins. The question was not whether Portugal was going to have strong growth after 2008 or a huge crash. It was whether it was going to have a mild crash or a huge crash. Good decisions at that point could have made it a mild slump. But it was probably too late when the global markets went upside down in 2008. It was probably too late for Portugal to have a strong recovery. They had left themselves in a position where they had a lot of debt coming in, so they had very little fiscal flexibility. They had weak financial institutions in an era when financial institutions worldwide were sort of contracting and becoming more cautious, not saying, hey, let's explore something. Let's figure out how to get loans to adventurous Portuguese businessmen. That wasn't happening. And so they didn't have much to do. They didn't act when they could have. They didn't act in 2003, 2005, 2007, when they had some space to act in the world economy. By the time they acted, it was maybe 2011, 2012. They'd ridden out the crisis. They'd started to come into a recovery. It just wasn't strong. And markets finally said, wait a sec. You guys want to keep borrowing money of these huge deficits even after your economy started growing again. And you want to keep borrowing money, and you have no plan to deal with this competitiveness. You have no plan to get your public sector wages under control. Transfers are growing like crazy despite only a modest increase in the number of retirees. We don't think that you can repay this. We don't think you have a plan to get yourself on track to repay this. And this is where we get to Dr. Price's remarks and looking at the long-term budget in the U.S., not the next year or two, but the next decades. We have to have a plan to say we can reasonably repay the debts we're taking out. You can end up in a situation where the markets say, we really don't think you have a plan to repay this debt. So that's why I looked at data, because you can't just take one item. We can't just look at Portugal's policies after the crisis and say, we're going to blame everything that happened in Portugal on what they did in 2010 and 2011. It was too late then. What they did mattered, but what they did before mattered as well. So what we did was pulled together data, tried to focus on sources that people don't know about. I had research assistants and interns entering data from PDF spreadsheets that were scanned in years ago at the IMF. That data you can now download. If you look at the back of your special report, there's a bit.ly link. You can download my data, play around with it. I'd love to see other researchers doing things that I haven't thought of, comparing that to other data sets. The data's messy. There's a lot of measurement error in anything. There's a lot of things that are reported as plans, and then people forget that this was the plan in 2009, not the result in 2012. So you got to be careful working with it, and you've got to sort of read, what does this really say? A few conclusions that I got from this whole look at the data. I think the biggest ones. First of all, austerity did not occur except where governments were forced to do it. You don't see huge cuts in the countries that weren't in a situation where they had to make big cuts. Secondly, tax increases hurt a lot more than spending cuts. We've heard about that. It's in the literature from before the crisis. Everything that I've seen confirms that the tax increases were the real slam on the economy. And then lastly, the non-crisis countries in the Eurozone, as we carve out everybody who had a major crisis, so the countries who could have kept their deficits large, they systematically increased the size of government from 2007 to 2012. If you look at the percentage of the economy that they're taking in tax revenue, on average that's risen, and in most of the individual countries it's risen. And if you look at their spending, that's risen above 2007 levels. It's risen well above 2007 levels as a percent of GDP. The data's in there. I'd love to see more work done on this. And Ray is going to come up, and Dr. Price, we're going to have some questions before we conclude.
Great, thank y'all. I'm going to take the first question, and after that, if you'll raise your hand, identify yourself and your organization, I'll call on you, and please wait for the microphone since this is being recorded. I realized in my opening remarks I did not use enough big numbers, so I'm going to remedy that in my question to Dr. Price. And I'm going to read directly from the Congressional Budget Office April report. Between 2015 and 2024, annual budget shortfalls are projected to rise substantially from a low of $469 billion in 2015 to $1 trillion from 2022 through 2024, mainly because of the aging population, rising health care costs, and expansion of federal subsidies for health insurance, Obamacare, and growing interest payments on the federal debt. Now, Dr. Price remarked that, he heard that the proclamations, the age of austerity is over. Salim mentioned that basically a commonality is that countries only engage on austerity if they're forced to. So my question for Dr. Price is this. What will prevent future budget chairmen to having to enact almost annual sequential sequesters dealing with budget deficits of $1 trillion as projected by the CBO?
Well, it's a stark question. I want to commend my panel mates here for the wonderful presentation that they provided. But the consequences are real and stark. I think what will prevent it is leadership, and that's what nations that have done the right thing and moved in the right direction have demonstrated, and that is political leadership, and leadership is necessary and vital. It's important to appreciate that all those big numbers that you lay out there, another big number is that we've had high record revenues coming into the federal government. So this is not a revenue problem, this is a spending problem. And so it's imperative that the American government, the Congress and the President get together and make certain that we reform these programs that are going bankrupt otherwise. The other thing I think it's important to appreciate, and I know that Salim does, and likely most folks in this room, but we spend as a government, as I mentioned, about $3.5 trillion a year now in total. $2.5 trillion of that is basically Medicare, Medicaid, Social Security, and interest on the debt. So that means that when you have a deficit of $1 trillion, we as a society could do away with the entire federal government, which sometimes people applaud, but the entire federal government, everything, roads and defense and education and transportation and judiciary and everything, except for Medicare, Medicaid, and Social Security, and we wouldn't even balance the budget. That's the magnitude of the challenge that we have. That's why it's imperative that we as representatives make the tough decisions to reform, strengthen, secure, save Medicare, Medicaid, Social Security, and do the things that are absolutely vital and necessary so that Obamacare doesn't become the huge monolith that it could and further choke our economy.
Great, thank you. Questions from the audience? Yes, ma'am, in the back.
What do you think is the role of exports in the different result that we've seen in Sweden? For instance, Sweden had a big export boom following a lot of the measures it took, and I guess I wonder whether that's an important factor or just a consequence of the policy, and whether we think that going forward, you know, when every country's economy is in bad shape, whether we can rely on that boost.
Thank you for your question. Sweden is a small and open economy, and I think that around half of our GDP comes from export. Probably that has a lot to do with that we have always been open to export and import. But obviously, it helped that we joined the EU, and we have like an internal free market in Europe. But that also makes us kind of vulnerable when the crisis comes. So the exports fell by 5% in 2009. So that hit our industries. So it's pros and cons, but definitely that's a good thing for us.
I think that Germany has shown a relatively large economy, right? They've shown that you can have strong exports even in a weak global economy. And the key difference between Germany and Portugal is that Germany had spent the previous years lowering their labor costs. And so that productivity was rising there faster than labor costs, which reversed the previous trend. They were sort of brought back in line, and that put them in a position where they could capture a lot of the export market. Portugal had wage growth with no productivity growth, and so they'd essentially priced themselves out of the export market.
I think that the Baltic countries would be another example of a strong recovery that was driven in part by exports, but then you have to ask yourself the question, what's behind that? And I think that's where structural reforms and the underlying competitiveness, flexibility of the economy comes into play. So I would agree that particularly for small open economies, this is a hugely fundamentally important thing, and that's why Hungary, I think, is doing so poorly as it is.
Thanks. Right there, front row.
Bill Beach with the Senate Budget Committee. This is for the panel. We were speaking recently with Paul Martin, who was Prime Minister of Canada during the period, Finance Minister, then Prime Minister, during the period when Canada consolidated. And he said that you really have to think tactically about how you go about doing this. His advice was no government program can be a winner. Everyone has to have a reduction. There simply cannot be a winner in the entire, in the sense of not being touched. And then you have to talk about the net interest payments as being the bogeyman in all of this. We got the same advice also from people who had gone through New Zealand's consolidation. So I'm going to ask the panel about what they think about that, whether you can have a successful consolidation politically with winners and losers, or whether all programs have to contribute, and how you would then sell this to the general public.
Sure. I mean, obviously, I don't have a sort of full picture in mind of all the consolidations that happened in the Eurozone and before the crisis to tell you whether the successful ones involved cuts across the board. But I think what's fundamental is really this aspect of of how reforms are communicated and whether the public is on board and understanding that there is no other way but to cut spending permanently. And one example, which I find striking, partly because I'm originally from Slovakia, is actually the example of Slovak reforms in the late 90s and early noughties, where there was a major fiscal consolidation accompanied by a number of other structural reforms, some of them quite painful actually. And after all that reform process was basically finished, there was very strong economic growth that followed. But even before the fruits of that growth were harvested, the political party that did most to put these reforms in place was elected into parliament with historically the highest number of votes in the post-communist Slovak history. So I don't think it's quite as simple as to say that reforms are costly politically. They don't have to be if they are communicated properly, if they are perceived as fair, if there are not significant constituencies that are really left behind to bear the costs. In the end, I mean, it really depends on how reforms are communicated, whether people are on board and understand that there are short-term costs that are unavoidable. I mean, it's really not the cost of reforms that we are talking about. It's the cost of years, if not decades, of bad policies that need to be corrected. And the question is how those costs are to be shared or spread.
I'll add to that one of the differences between Canada and New Zealand's reforms and ones we're looking at now is they took place in a nice demographic era when the baby boomers were all working. And so right now, most countries are facing a case where they've made promises, these folks are coming to retirement, and so the big hit on the budget, like Dr. Price said here, it's true elsewhere as well, is in pensions and medical care for the elderly. And so you can't sort of spread a 1% cut from everything, as we saw with the sequester or something like that. Just doesn't take enough of a bite out of this sort of huge increase in the costs of retirement. So they did it at a better time. That's one lesson. From what we've seen in this crisis, unfortunately, transfer payments have grown a lot. That's what you expect in a bad economy, but there's no indications, except maybe in Greece, that there's really severe cuts in entitlement programs. The thing that has been cut is the easiest to cut, and is probably the worst thing you should cut, the last thing you should cut, is government investment. It's the one thing that if you sort of say, hey, where do these cuts do the most harm, public investment is probably the most harmful thing to cut of anything you could choose. Transfer payments and salaries for government workers are the best things to cut. And those tend to be the best protected. So unfortunately, we've seen some of the countries that have done cuts have done them in places where they're eating their seed corn instead of changing their diet.
I think for Sweden, as I said, we can, in Sweden, we have two examples where the people in the government has won elections by being kind of, how do you say that? By being responsible with tax money. Not to say that they can cut anything. We have like an enormous we have enormous subsidies for families, kids and daycares and stuff, and for pensions too, and we would never be able to cut that. But you can cut benefits and still be re-elected, and you can, I think what they say now in Sweden is that if you can't show that you're responsible with tax money, you will never be elected. So therefore, the two blocks, we have an election coming up in September, the two blocks competing for power are competing about being most conservative with the budget. So it's very boring, but it's probably quite good too.
Poor thing.
So the message, Bill, is that you can cut benefits and still get reelected. So you have to be responsible with taxpayer money. I think the challenge that we have in order to sell it to the American people is that we've got to be delivering the same message throughout the government. And right now, that's a huge problem. That's why I mentioned in my prepared remarks the issue of demagoguery, because it is so simple to demagogue this issue and pit one group of Americans against another group of Americans. And as long as parts of our political leadership continue to do that, read the White House, then it will be incredibly difficult to sell the American people on the absolute necessity of the reforms that need to be made. Because these are going to be very, very uncomfortable for many people. Should everybody be reduced? Likely, yeah. What happens if we don't? Well, at some point, you have to pay the piper, as Ray, I think, mentioned in his remarks. At some point, people don't, you can't run a deficit because nobody's going to loan you the money. And when the bondholders say thanks but no thanks, then as you know, things spiral out of control pretty doggone quickly. And that's what we need to avoid.
Great. Unfortunately, Congressman Price is going to have to go for votes. You got votes, I was just informed. So maybe one quick final question down here.
Yeah. My question is actually simple to Congressman Price. I know we are relying on China to lend us a lot of money, but China is now, well, everybody expects China will have a crisis very soon. So how about one day if China is not able to, I don't mean not willing to, but not able to lend us money, what will happen?
Well, there are a number of sovereign wealth funds that are loaning us money, but look, we've got to get our fiscal house in order here. And as I mentioned, one of the hallmarks is that we ought not be spending more than we take in. So balancing the budget, which we proved in our budget one can do within a relatively short period of time, is absolutely vital. With the energy boom that we have in this country, and the potential that we have in this country to be energy independent, and the potential exporting opportunities that would provide, then there is it's within sight to have a balanced budget in this country, and therefore then you don't have to worry about anybody else from a fiscal standpoint, and that would be a glorious position to be in. It would also result in a wonderful incentive and boom to our economy. So it's self-fulfilling. You take care of the spending side, and actually the economy grows at the same time. So.
Well,
I apologize for having to leave. I've got a vote apparently, and I appreciate the opportunity. And thanks for my panel members here.
Thank you.
We'll be giving each a call and trying to track Sweden's performance and not Hungary's.
Please join me in thanking our panelists. Thank you. Thank you very much. I think we'll conclude now since we're a little over time. I'm sure our panelists will be glad to answer any specific questions that you may have with the report itself or their countries. Again, thank y'all for coming, and hopefully to see some of y'all back in 2 weeks for a chairman camp. Thank you.